Does it sound mind-boggling when I say you can generate 15% returns even during market crashes? Yes, you heard it right. It is true and absolutely possible. It's not through stock market, cryptocurrency, or any other volatile asset. This kind of safe haven returns are possible through instrument called as debt securities. Debt securities are financial instruments representing a kind of debt or a loan issued by one entity to another. Entities which take such kind of debt in order to raise capital are government or corporations, whereas an entity who funds this debt are called investors. Investors basically invest their money to buy debt securities in order to seek a fixed annual interest with a promise to get entire principal amount back at maturity. Now the main question here is, what exactly will be the interest rate on these debt instruments? Well, interest on these securities depends on the base interest rate, also called as policy rate set by central banks. This policy rate serves as a benchmark for any kind of loan made in the economy. It is therefore a tool for central banks to stabilize economic conditions by changing this policy rate. They can either decrease or increase this policy rate in order to either boost growth or to tighten the economy. So how does it relate to debt securities? In case of higher policy rates set by central banks, debt securities will have higher interest rate and vice versa. Hence, interest rate on debt securities is directly proportional to this benchmark policy rate. In order to understand this, imagine a scenario where a policy interest rate is kept low by central bankers, which basically means any kind of debt or loan will be cheaper in the economy. Hence, all debt instruments will have low interest rate since it's based on this benchmark. This will lead corporations being able to raise capital by issuing bonds at a much lower interest rate, hence improving their margins to be more profitable. This will also lead to increase in demand of luxury and volatile assets, since anyone can now take a cheaper loan from banks. They can use this money to buy a house or a car, or else they can choose to invest this cheap money into stock market or cryptocurrencies, causing these kind of volatile assets to be highly inflated. Corporations will also be generating higher profits due to increase in demand as well as margins. This looks like an ideal scenario where everyone is happy and getting what they want. But ask yourself what this will lead to. Yes, you guessed it correct, inflation. This will cause inflation to have sharp rise, since demand simply kept on increasing due to cheaper debt. This will cause central banks to be concerned about controlling this inflation in order to stabilize economy. So in order to do that, they use their same tool of policy interest rate. They start increasing policy interest rate up to suitable level, causing debt in the market to be more expensive. This in turn will also lead debt instruments to have higher interest rate, since it was directly proportional to this policy rate as seen earlier. This causes inflation to come down due to unavailability of any more cheaper loans in the market, but this will also mean that new bonds issued by government or corporations will be of a much higher interest rate based on new policy rate. Hence, it results in decrease in a demand of previously issued bonds and therefore reducing their bond prices. In simple words, this increase in policy rate not only resulted in inflation to come down, but also on reduction of existing bond prices. This basically proves that here is an inverse relationship between increase in policy interest rate and bond prices. Therefore, let's now imagine an exactly opposite scenario. Imagine that we are almost at peak of interest rate cycle, and economy is already too much tightened up. This also means bonds which has been issued in the market currently are of higher interest rates. Thus, in order to boost demand for a better growth, central bankers decides to start cutting interest rates. This results into debt securities to be issued at much lower interest rate, since new bonds which will be issued now will be of low interest rate. This will cause demand of existing bonds which were of already higher interest rate to increase even further, hence resulting in bond investors to get some extra returns on top of their annual interest payments in this environment. It looks awesome in theory, right? But let's look at it with a real-life example now in context of Indian bond market. These are returns of debt funds in India over last few years. What you notice here is there are two exceptional years where returns on these debt funds are of double digits, during a year 2016 and 2020. Now, if we correlate this with policy interest rate of Indian economy, you will find that during these 2 years, there had been interest rate cuts done by Indian Central Bank, hence resulting in handsome double-digit return with almost negligible risk. Let's see where are we now in terms of interest rate cycle. We are already at peak in terms of interest rates, and it's not only in India, but in most of the world's economy. In fact, interest rate cuts have already began in most of world's economy. Hence, this is the time to lock in on these awesome double-digit returns in coming year or two. Now we can clearly see it's possible, and in fact we know exactly how. Next obvious question is how can we participate in it? Well, you can directly purchase a bond from a government websites, or else nowadays from any of your brokers. But a better way is to participate on it through debt funds holding multiple bonds. Debt fund can hold multiple types of bonds of various types, making this investment diversified and even lesser volatile. There are various factors we need to consider in order to select any debt fund. They are yield to maturity, average maturity, modified duration, credit risk, riskometer. Let's go through it one by one. Yield to maturity is an expected yield or interest rate a fund offers. Thus you can consider this as an interest rate for holding debt fund under normal conditions, keeping all other things unchanged. Next is average maturity. This tells us about average duration of bonds present in a debt fund, thus giving you an idea about what kind of bond maturities this fund holds. Anything more than 7 to 8 years can be termed as long-term. Third is modified duration. It's a measure to estimate the sensitivity of a bond's price to the changes in interest rates. So, for example, if modified duration of a debt fund is 8, this will simply mean that in case interest rate drops by 1%, price of a debt fund will increase by 8% and vice versa. This is a key parameter for us, since this sensitivity to interest rate is what will provide us extra returns on top of yearly yield. Next comes a credit risk. There is certainly one risk in this, and that is what if government or corporations which has issued bonds that defaults on its payments. This is called credit risk. There are wide varieties of ratings issued on bonds by various credit rating agencies. This is an overview of possibilities of credit ratings. The ones at the top are called highly rated AAA bonds. Whereas if we keep going down below BBB, they are called junk bonds due to very high credit risk. So how are we going to deal with this? First of all, we are talking about debt funds, not a single bond of some corporation. Fund holds hundreds of bonds, so even if one of corporation defaults, it doesn't impact debt fund much. On top of that, I personally prefer debt funds with highest credit ratings, since risk mitigation is my first priority when I look on debt instruments. Then the last comes riskometer. To assess overall risk category, it's also good to look into riskometer, present on debt fund fact sheet. It gives us an idea about risk in the fund ranging from low to high risk based on interest rate risk and credit risk a fund offers. Now, based on these parameters, let's go through one of the fund's fact sheet to look how exactly it looks in real life. Before going into a fund fact sheet, a quick disclaimer that it's not an investment advice but just an example for educational purpose. Kindly do your own research before making any investment decision. This is a fund fact sheet of a debt fund from India, called as Nippon India Nivesh Fund. Firstly, let's go through its holdings. This fund holds only government bonds, that too of high ratings of AAA and equivalents. So this tells us that we are basically looking at highly rated government bonds through this fund. Next comes other important parameters such as YTM, so it has yield to maturity of 7.07%. Telling us that this is an interest or yield we will get from this debt fund, keeping everything else unchanged. Now, if we look into average maturity, it is 22 years, clearly indicating that it's a long-duration fund. And if we look into modified duration of it, it is 10.72. If we just put these two parameters, YTM and modified duration from fact sheet here, what does this modified duration actually indicate? This indicates that if policy rates gets cut by 1%, demand of this fund, hence its price will get increased by 10.72% due to phenomenon we have seen earlier. Hence, it can be stated that considering a 1% cut in interest rate, we are looking for a return of 7% from yield to maturity, plus a return of 10.72% due to increase in funds demand, which comes to be around 18%. Awesome, right? It certainly is. For sake of being more conservative, even if we consider a rate cut of only 0.5%, returns will be 7% from yield to maturity, plus approximately 5.36% due to increase in funds demand, which comes to be a total of around 12%. Still good enough, right? In both cases, it's a double-digit return, almost similar to yearly return of stock market. But here a beauty is it is without any major risk or volatility. So as a summary, we have seen how just by being aware of common economic conditions and knowing some key concepts, we can generate higher returns with logical reasoning and without any speculation. This is called smart investing. Hope you would have enjoyed a video. Please hit a like button and subscribe to the channel. Also, do not forget to hit the bell icon. Thank you for watching.